I've been asked about this a lot of different times. What do you do when you have relative equal highs, but you also have relative equal lows? Because logically, you'll be thinking, well, probably we're going for the lows and then for the highs again. But at the same time, well, we also have liquidity higher in here, right? So we might as well just go higher first and then we continue lower. Now, there's basically two ways how you can easily just know which one of these is going to be taken out first. No, the very first method is going to be that I just like to wait out until the first one of them is going to be taken out. Simple as that. So if the relative equal lows are going to be taken out first, then I'm willing to trade higher if I have the confirmation in this little bit of price action leg, because this one is going to be our established movement. And then from here, I will be willing to take the continuation higher with a negative risk reward, of course, and then up onto the upside. Now, the second thing is actually identifying which of these is going to be taken out first. So how can we really confirm that we're going to take out the relative equal lows first before the relative equal highs? And I want to ask you a very simple question. Which of these liquidity points holds more weight? What do I mean by weight? Weight is basically defining how much liquidity resides on the certain highs and lows. If you would have said that the relative equal lows hold more weight, then you would be wrong, because the relative equal highs hold way more weight in terms of liquidity. Way more retail traders are putting their stop loss above these highs, because why? We have reject offered one time, second time, third time, and perhaps for some this is even going to be a fourth time, but this is quite far away, so this is already subjective and I don't really count it. But if we are going to compare it with the relative equal lows, these are not as strong. Now pay attention, there's way more candlesticks, so basically the wicks of the entire candles reaching to this high, but we're still not able to take them. So which is also telling to me the market is looking for the relative equal highs, not for the lows. However, we also know in order for the market to go in one direction, it has to go take fuel. So basically this low is being taken out and then only it can continue higher. So basically this is the same scenario in here. In order for us to trade into relative equal highs, we need to take out the relative equal lows first. This is going to be our fuel, and then from there we can continue on to the upside. This is basically how you're going to fix this dilemma of when you have relative equal highs but also lows. Once again, the first approach is what I'm going to recommend to everybody that is new to my way of trading. The second approach is going to be if you're more advanced into this way of trading. If you understand liquidity well, then go for this one. So here's going to be an example of the very first method. So we have relative equal highs, but we also have relative equal lows. Notice how I'm not counting this low that is contributing to relative equal lows. Why is that the case? Some of you might be saying that this low is also relatively equal close to this low, which may or may not be. This is very subjective, but here's a very easy way and actually mechanical way to know that this does not belong to relative equal lows, because this is actually going to cost you a lot of trades if you don't understand this. The reason for that is, for relative equal lows at least, you have to count the very lowest point, so the lowest low, all the way to the highest low. If they are not close to each other, those are not relative equal lows. So again, this low might be close to that low. However, the very original low, the lowest point basically, is not close enough to the highest point. This counts the same for relative equal highs, of course. We have to take the very highest point of the relative equal highs and also the very lowest point. If they do not align with each other, then these are not going to be relative equal highs. Now in that case, it's a different scenario because liquidity has already been taken, which means that ultimately we only have these highs contributing to relative equal highs. So once again, how are we going to identify if we're going to trade for the high or for the low? Once again, we're going to wait if one of these is going to be taken out. So once again, once we have traded into relative equal lows, now is the time to trade into relative equal highs. The thing is, most of you guys are also going to mess this up. You want to trade all the way higher into the relative equal highs, right? This is problematic. You don't even know if the relative equal highs are going to be taken out. The only thing that you are sure about is that there is a bunch of stop loss in there. When that is going to be taken out is a whole different story on itself. So you don't even want to target all the way to the relative equal highs, but you want to have a very minimal risk to reward, aiming close to 10 pips as a take profit, and your stop loss can be 50 pips. From here, just let the trade run. So here's going to be an example for the second method. Previously, I told you that you need to wait the confirmation. So we have relative equal highs in here, and we also have relative equal lows in here. Notice how I'm not taking this low. Previously explained to you, you have to measure the lowest point all the way to the highest point, which these are not close to each other. So there is no relative equal low in there. Now we can even extend this entire line all the way to the left, because these are even more relative equal highs to make it even more obvious for you that the price is favoring to the upside. However, we need to identify where we're going lower. I previously told you we need to take out liquidity in order to go to the more favorable direction, which is the highs. But there's actually a little bit more confirmation than just that alone. We have this entire price action gap. A lot of you guys like to trade into the price action gaps and then away from them. I like to see a body closure below that entire gap, and only from that point on I can expect higher prices. So let's just see, this trade has traded lower, this entire body closure has been filled out, and from this point on we are looking for a confirmation candle. The confirmation candle is basically going to show us high momentum, such as in this case. Price tried to go lower, which it actually did, but the most important information out of this is it was not able to stay there. This is exactly why we pushed higher. Buyers are getting in control now, and then from here we're going to take our position. 10 pip take profit as always, 50 pip stop loss approximately. From here you're just going to take a trade, and that's a take profit hit. Now let's talk about the elephant in the room. Couldn't we just extend our entire take profit to get more out of it? Yes, we could. And that's exactly what I'm going to show you now. Alright, so here's going to be the first example with the first method. So first things first, we're going to mark out the relative equal highs and also the relative equal lows. Once again, we have two swing lows being relatively equal close to each other. Those are relative equal lows. Now the second thing that I want you to pay attention is that we're simply in an uptrend, right? So I don't want you to zoom out months and months out of the time frame, but you have to understand the context of the market. So clearly we are just trending upwards because we're having higher highs and also higher lows. We're breaking structure, new higher high, breaking structure, new higher low, and this just continues up until the very present price action. Now the next thing that I also want you to pay attention to is not only the uptrend in itself, but also the order flow. How do you determine order flow? It's when you have an FEG and price has fallen back into an FEG, was not able to close below it. So as you can see, this entire candle did trade into the FEG and even extended the entire low of the FEG, but it was not able to stay there with a body closure. This is really what matters. From there, it pushed upwards and has broken structure once again. This is basically what is going on onto the higher time frames. And as you can see, you have multiple FEGs being respected every single time. So now that we know that, most likely we are going to go for the relative equal highs, and this is going to be more favorable. However, this is going to be the very first method, which is more simple. We simply just want to wait until one of these sides has been taken out. And then we want to wait for something very specific after that. So first things first, we're going to wait until the relative equal highs or lows have been taken out. And notice how we're pushing higher, and a lot of people are just going to take a long in here. And it will be a very logical level. Once again, we have liquidity higher. There is stop losses above. It's not that the liquidity isn't lacking. The liquidity is there. It's just the timing of the market. Remember, you not only have to know where the price is going to go, but you also have to know when is that going to happen. Because I can sit here all day and tell you that the relative equal highs are going to be taken out. But if the price does something like that, and only from that point on it goes to relative equal highs, then it's kind of useless information, isn't it? We want to pay attention. These candlesticks have traded higher. The regular retail trader is now thinking, okay, I'm just take a buy position and then on to the upside. What most of the times is going to end up happening, he's just going to FOMO in and he's going to clearly get stopped out, especially because this right now is just on a daily chart alone. We're not even breaking down the entire chart into multiple time frames. This is just the daily chart alone right now. So in here, this was the first significant move. Why? We still have the relative equal lows. Don't get me wrong. The relative equal lows are still intact because we have that swing low and also that swing low. Problem is just that this swing low has already been taken out. Now this is going to be a little bit more advanced. So I really want you to pay attention now. We have that swing low, and these swing lows were basically contributing to the fact that, okay, these are relative equal lows. Now though, this swing low has been taken out, but this one hasn't yet. So what are you going to do now? These are going to be new relative equal lows. However, that also means, because this low has already been taken out, there's less liquidity. So before that, we had a lot of liquidity because the longer relative equal highs or lows are going to stay, the more liquidity is going to accumulate of these highs and lows. So in this one, there's a lot of liquidity because as you can see, we have now traded into it. So now that entire liquidity becomes weak. There's less liquidity, which is a very good selling point to trade into first, take liquidity as fuel and then onto the upside. Once again, we're still only looking at which side is going to be taken out first. As you can see, the low has been taken out, but we're still not going to enter a trade. This is still not enough for us to actually trade onto the upside, because as previously mentioned, what we like to see is momentum. I want to see a very big bullish candle onto the upside, and then from that point on, I would be willing to take a trade. So let's see what is going to happen, and always pay attention. Literally everything that is happening right now is information. Yes, I'm teaching you this very simple concept of just trading into relative equal highs or lows, but you have to understand the nuances, or else don't blame me if this doesn't work. It traded lower, left a very big wick onto the downside, and was not able to stay there. This is basically the very first confluence that we like to see, that right now the bias is changing. Remember guys, we are still in an uptrend, right? I've told you this before. So right now, this is just going to be the liquidity grab. From here, once again, we want to see a big candle onto the upside. Before that, I'm not willing to participate in any trade. We're still hovering around. I can't tell if we're going for the high right now or not. Most of you guys would already be taking a trade onto the upside, you know, YOLO just in onto the relative equal highs. But that's where you're going to fuck this up. We're going to wait until we have a big bullish candle onto the upside. With my way of trading, you have to be patient. I don't want you to FOMO in. I'm not going to teach you something that is going to work 1 month and the next month it's not going to work. So be patient. Once again, we don't see what we want to see. Now in here, the things have changed. We have a big bullish candle, but also we have taken out liquidity from the previous candle low. Since we're on the daily time frame, on the top left you can see it, we've already taken out liquidity, which is going to be the previous day low. From that point on, we still have the relative equal highs. Liquidity has been taken of these relative equal lows. And you might be saying, why have I marked out even more liquidity in here? Simply as that. This basically is going to be your internal relative equal high, and that is going to be your external relative equal high. So now the setup became even more likely to play out. We have the momentum with internal liquidity, external liquidity. There's basically not much more that I could ask for in a trade. So in this point on, if this is going to be the 1 hour time frame, because this is most of the times the time frame that I like to enter trades on, from here you're going to take a trade onto the upside. Most likely it's going to be a 10 pip take profit and a 50 pip stop loss, aiming close for 1 for 0.2, such as in this case. And from here, this is going to be an easy take profit. Now, but as mentioned previously, how can we extend our take profit to make more money? In that case, I'm going to skip to the next day candle. And what I need to see is that the previous day high has not been taken out by this current candle. So we've already taken out the previous day high, so we're not allowed to take a trade on that one. So the next day has also taken out the previous day high, so we simply just have to wait another day. We've taken out the previous day low. Once again, I need a day where the previous day high has not been taken out. And this is exactly what I wanted to see. So the difference between all of these different candles that we're looking at in here, we have taken out the previous day high every single time before the 0 AM candle. Now, what do I really mean by that? Right now, the current time is going to be 0 AM UTC standard time. So we're quickly just going to run down the 4 hour time frame, and then we're going to go into the 1 hour time frame. What can we spot? This is basically already your established movement. You see these candles, they are clearly showing you that price wants to move higher. So there's not really much information on the forward chart alone. So we're going to drop down onto the 1 hour time frame. And this is basically already going to be the position. Now in that case, usually we like to aim for a 10 pip take profit. Since the likelihood of this trade playing out is very high, we can extend our entire take profit. Now keep in mind, I don't want you to extend it by too much. The overall stop loss would still have to be 50 pips or something close to that, such as in this case. And from here, I simply want you to take a trade. Even if the trade goes into a drawdown, that's no problem. That's what you're prepared for. You have done the entire analysis beforehand, and that's a take profit hit. Now, a very big misconception, and I want you to pay attention to this, is that a lot of traders are going to extend their take profit to relative equal highs. And I get that. That is not a bad idea per se. Problem is just that price is never going to reach into the internal relative equal highs or external relative equal highs if you're going to do that. Or it might as well just do something like this. Go into your stop loss and only then go into the liquidity. So be careful of that and don't be greedy. So now I'm going to explain to you an example where we're going to use the second method. So basically, we are not going to wait for one side of the market being taken out, and we immediately want to take advantage of the first move. So first of all, we need to analyze this entire price action here. First things first, what can we spot? At the very recent price action, what gets straight up into my eye is these relative equal lows. Now the next thing is also that previously we had relative equal highs. This is what I want you to pay attention to. Even when relative equal highs or lows have already been taken out, that doesn't mean that it's useless information and you're not going to take anything out of it. It means that the market had liquidity to trade higher, and then from here on it has the sell-off. So now you could expect the relative equal lows to be taken out. This is basically going to be your very first indication, because liquidity has been taken. This is the fuel. Now we can continue lower. Now the next thing is also this entire price action. Basically this entire high, where has it fallen back into? Look at the left. Small, but we still have an FAG. Price has traded into it. Now, of course, right from the spot, you cannot really notice it, so you always have to check with those FEGs, align them, and see if it actually has traded into. So in that case, we still are not just randomly trading anywhere. This is very important, guys. So we already have two confluences. We had the fuel to trade onto the upside to now trade lower. The second thing is going to be the FEG. So from here on, we basically want to trade lower. But once again, we need our established movement for that. And before that is going to happen, we're not going to take a trade. So let's see if we're going to get what we want. Now, is this established movement to you? Yes, it is. Why? Because this entire candle has taken out its previous, its second previous, and its third previous candle basically. And all of these single candles have been taken out by one single candle. So this is going to be your established movement. This currently, if you're going to look at the top left, is on a daily time frame. So you want to ask yourself the legendary question, which I always like to ask. Are we going for the previous day low or are we going for the previous day high? Probably we are going to go to the previous day low because this candle is already suggesting that. So we don't even need more information in that sense. So we're just going to drop onto the 4-hour time frame. Some of you might be already wondering, you have just told us that this is going to be the second method where you have relative equal highs but also relative equal lows. We didn't really have relative equal highs onto the daily time frame, but if you're going to look closer, what are those going to be? I am going to move the previous day high for now. These are going to be what? Of course, relative equal highs. Now these relative equal highs, do they matter more than the relative equal lows based off what I've just told you, such as the FEG that we have traded into, have taken out liquidity, and also just overall trading lower right now because we have taken out fuel in here. So remember, this is the previous day low. Most of you guys, what you will be doing is just trade onto the previous day low, stop loss 50 pips, because this is what we usually do. The problem in here is just that, remember what we did in the last trade that I have just shown you. Pay attention, guys. We had internal but also external relative equal lows. In that case, we really only have external relative equal lows. Right? We don't really have something internally that is going on right between this price action. So we are not basically able to extend or take profit. So going back onto the 1-hour time frame, the original position is always going to be 10 pips, take profit, and 50 pips stop loss. This is not going to fail you, and most of the times it is just going to work, simple as that. But once again, you want to maximize profits, so stick to the end. Basically, we cannot take the trade like that because we don't have enough information and confirmation for that. So we can only take it like so. This was a take profit hit. So we're going to move on onto the example where we can actually optimize our entire profits. So for that, you basically have to wait it out a little bit more. I've told you previously, you want to have internal and also external. So these are going to be your external relative equal lows. Put it to the bottom. And then in here, you want to see your internal relative equal lows. And now you really have to lock in. You see, this little bit of price action is already your relative equal lows. Now I've already marked it out because that's what we wanted to see. But this is already what has happened. Most of you guys will be saying, well, but relative equal lows and highs is only when you have one swing low being created and another swing low being created. Those are going to result in relative equal lows. Yes, but this single price action, if we're going to go into the 4-hour time frame, are going to be relative equal lows. And with internal relative equal lows, I am not that strict. Because once again, they're internally, the market just can't be perfect. This is our confirmation to now trade onto the downside. Stop loss is going to be 50 pips, which is closely to a relative equal highs, so we're just going to put it in here. And guys, please don't do something like that. This is not going to work over the long term. It might work a couple of times, but don't do that. You want to maximize your profits, but you don't want to be greedy. So the max we would be willing to take is basically optimize it something onto the 1-hour time frame. So now we're in the 1-hour time frame. Can we see some kind of level that price would reject off from? You can see this entire FEG. This will be the first point where I would expect the price to basically reverse on us in case we are wrong. Now, of course, we are still anticipating for the price to trade all the way lower into the internal relative equal lows and also the external relative equal lows. But we're just preparing ourselves for the worst case scenario. So we're only going to put our entire take profit right at the FEG. From here, we're just going to let the trade run, and that's a take profit hit, guys. So we're even going to let it run even further. We have gone on to relative equal lows. This will happen a lot of the times, but guys, don't be greedy. It's so simple, and I really don't understand why all of these gurus are making it so complicated. When in reality, this thing is what I do on a day-to-day basis. It's so easy, it's simple, and most importantly, it's profitable based on the backtesting sessions, which you can see on the screen right now. Now, these are just some of my backtesting sessions, which have been fully journaled and documented in my membership. But not only that, I am going to provide with you everything that you need in order to become a profitable trader. No matter if you have been trading for 3 years, 5 years, I've even had people who have been trading for 7 years and still haven't found profitability. And after joining my mentorship, they have made a lot of money so far. If you want proof, just go to my Discord. It's all documented in the testimonials. No, but no pressure. You can also just watch my regular YouTube videos. They will also help you a lot throughout your entire journey. Just know that being guided is always going to be faster. On this side of the screen, there's going to be the full masterclass explaining everything from A to Z, what we have just talked about, but in more detail, more nuances, and a full backtesting session. Make sure to watch it fully from the start all the way to the finish so you really don't miss any key details. Now like the video and subscribe to the channel for more. See you guys next one.